Hi everyone, welcome back to Money.Finesse.Mindset. This is episode 11. What if I told you there is an account that lets you save for medical expenses and invest for retirement completely tax-free? It is called HSA, or Health Savings Account, and it might just be the most underused, underrated, and underappreciated financial tool out there. Here's the kicker. While about 61 million people have access to HSA, only 75% or 46 million people actually contribute. Even worse, just 9% or 4 million people invest their balances to unlock the full benefits. That minuscule figure is a testament to how underused, underrated, and underappreciated HSA remains. Look, if your employer offers a high deductible health plan or HDHP, you might already have access to HSA. And trust me, it can make a huge difference to both your health and your wallet. Even if you don't have one yet, understanding how it works could still pay off down the road. So what makes HSA so special? Two big things. First, the triple tax advantage it offers. And second, how nicely it fits into your long-term financial and retirement planning. Let's break down both. As far as I know, HSA is the only financial tool out there that gives you triple tax advantages. That means your contributions go in tax-free, your balance grows tax-free, and your withdrawals for qualified medical expenses are, tax-free too. Sounds amazing, right? But there are a few key things you should know, so let's dive in. When it comes to contributions, the Internal Revenue Service, or IRS, sets the rules. Every year, they adjust the maximum limits. For 2026, there are $4,400 for self-only coverage and $8,750 for family coverage. If you are 55 or older, you can contribute an extra $1,000, bringing your total to $5,400 for self-only and $9,750 for family coverage. There are two ways to fund your HSA. Option 1, payroll deductions through your employer. This is the easiest and the most straightforward route. Your contributions go in 100% pre-tax, even before Social Security and Medicare are taken out. Some companies even match your contributions, so you could hit the annual HSA limit without putting in the full amount yourself. Since everything runs through your employer, you also don't have to worry about accidentally over-contributing. The downside, you are stuck with your company's chosen HSA administrator or provider, which might offer fewer investment options or charge higher fees. Option 2, do it yourself. Here, you decide when and how much to contribute, and you can pick any HSA provider you like. Just remember, if you choose this option, the money you put in your HSA is tax-free for federal income tax, but it is not fully pre-tax. Confused? Let me explain. Let's say you contribute $1,000 to your HSA on your own. You can claim a deduction for that amount on your federal income tax. But the Social Security and Medicare taxes that were already taken out of your paycheck are gone forever. Put another way, with option 1, you save federal income tax plus Social Security and Medicare taxes. With option 2, you save federal income tax only. Also, if your employer offers matching, you will not get it if you go solo. And finally, you will need to track your contributions carefully. Overfunding your HSA triggers a 6% penalty each year on the excess amount until it is corrected. Now, let's talk about potential earnings. This is where a lot of people missed out. Many assume that once they set up automatic payroll deductions for their HSA, their work is done. That is not true. Large HSA providers like Fidelity, Health Equity, HSA Bank, and Optum Bank let you invest your HSA balance in stocks, mutual funds, or ETFs. And the best part? Any interest, dividends, or capital gains from your investments are completely tax-free. Yet, only about 9% of HSA holders actually take advantage of investing their HSA balances. I will admit, I was not one of them. For over 15 years, I treated my HSA like a plain old checking account, only using it when I needed a reimbursement. The investment tab was right there in front of me, yet somehow I never even bothered to look at it. When I finally realized my mistake, I was so annoyed with myself for leaving that tax-free earning power on the table. Don't make the same mistake I did. Selecting your investments only take a few minutes, and once you do, your money can grow quietly on autopilot. Finally, let's talk about withdrawals. Not every medical expense qualifies, so double check before filing a claim. And be sure to keep all your receipts. If you cannot show proof, you could face a 20% penalty plus income tax on the withdrawn amount. One really neat feature about HSA withdrawals is that you don't have to file claims right away. You can save your receipts and withdraw later. How does this strategy work and why does it matter? Here is a hypothetical scenario. Suppose I open an HSA on January 15, 2017 and start contributing. 6 months later, a trip to the dentist costs me $910. I could take the money out of my HSA right away, or I could do this instead. I decide to pay out of pocket, giving my HSA balance more time to grow through choosing investments. Assuming a moderate 5 to 7% annual return over 8 years, that original $910 could grow to around $1,400. When I finally claim the reimbursement in March 2025, it is completely tax-free. And thanks to 8 years of investment gains and compounding magic, that $910 has earned an extra $490, which can keep growing in the HSA for future use. Now, this example assumes steady growth, but markets do move in cycles. Some years will be up, others down. Over time, though, staying invested generally helps your HSA balance grow through compounding. As long as you use your HSA funds for qualified medical expenses that occur after opening the account, your withdrawals will always be tax-free. Break that rule or don't have receipts to support your claims, and you could face a 20% penalty plus income tax on the amount. Now, for some good news, once you turn 65, the 20% penalty on non-qualified HSA withdrawals disappears. You can use the funds for anything. Spending on eligible medical expenses is still tax-free, as long as you keep records to prove them. Any other withdrawals are taxed as regular income. The money in your HSA is yours forever, even if you leave your job. That is why a health savings account is not just for healthcare. It is also a powerful retirement tool. I hope you find this episode helpful. If you already have an HSA, don't let it sit idle. And remember, you don't have to stick with your company's HSA provider. You can shop around for one with better investment options and lower fees. Take care of yourself and your finances. See you next time.